go ahead and call our meeting to order. This is the April 19th Pension Committee meeting. Our first order of business is to consider minutes of the January 18th meeting. Are there any questions or changes to the minutes?
Motion to approve.
Second. Okay, all those in favor? Aye. Any opposed? Okay. Next, we have the contract with Fiducient Advisors. Fiducient and Chartwell merged their practices a few weeks ago, and as far as I understand, our team will still be led by Natalka and her group. Our fees will remain the same, but because it is a new entity, we needed to get a new contract approved. Are there any questions about the contract or any of the information in there?
So we're just substituting names.
That's basically it.
Okay. I have no objection. Move to approve.
Okay. Is there a second?
Second.
Okay, all those in favor?
Aye.
Any opposed? Okay. And this contract will also go to council later this week, Natalka.
Okay, thanks.
Okay, so now we have Natalka and Chris Rollins here from Fiducient to go over our, first quarter 23 monthly and quarterly performance and flash reports. So thank y'all for coming.
Okay, well, thank you. I've already introduced most of you to Chris Rollins, who will be the co-consultant from Fiducient. And I thought since this is our first meeting as Fiducient, it would be nice to take a few minutes to do a little bit of an intro, both to the firm and also Chris's background and his work in the public funds arena. And then I will come back and we will do your performance report. But right now, I'll turn it over to Chris.
Great. Thanks, Natalka. Good morning, everybody. I'm Chris Rollins. I am a partner and senior consultant at Fiducient, and by way of background, consulting to public plans has always been near to my heart. I began my career at the City of Hartford in the pension group, spent about 7 years there out of college, so getting acclimated to valuation reports, manager research, and working with pension committees, and now head up our public fund practice at Fiducient. I did spend several years at USI Consulting Group. I point that out. I was president of USI Advisors. They're your actuary. It's a small world. So I saw the VAL report that Natalka shared with me. I was able to go through some of the assumptions and learn a little bit more about the plan's financials and the discount rate. I recognize that it's a small world with USI, so you're in good hands there. In talking with Natalka, I thought what we would do today is just introduce Fiducient Advisors and who we are, and really the purpose here is just to kind of extend the resources at the firm on an ongoing basis with Natalka as the lead consultant. So just get you acclimated with who we are and our presence in the public fund space, which we've been consulting to public plans for about 3 decades now. Probably considered the premier consultant to public plans in the Northeast, where a majority of our public plans reside, because we are a predominant Northeast firm. And Fiducient is a marriage between FIA, Fiduciary Investment Advisors, where I've been with 14 years or so, and DeMeo Schneider. So we merged 3 years ago, and then we rebranded the firm as Fiducient. So I'll provide some of the optics just on the firm, and then just more importantly, just the resources that we'll bring to the table, and kind of our reporting. And I want to talk a little bit about our governance calendar, because we do really like to focus in on educating the committee around fiduciary training and responsibilities as stewards of public fund assets, and then sort of the bench strength for the manager research group and the investment committee, and how those ideas flow into our client portfolios. So if there's no maybe initial questions, I'd like to maybe just kind of go through a couple of slides, intro slides on the firm.
I'm just going to hand out the hard copies as well, just in case.
Yeah. And I do want to be respectful of time. I just want to recognize the cadence of your meeting. So if you tell me to kind of move along, I won't be offended. Please. And I spent a number of years consulting to Knox County, so I've been to Tennessee quite a bit, so please push me along where needed. So just, Fiducian at a glance, so given the combination of the firms almost 3 years ago, and very similar firms, we have over 200 associates at the firm. About 35% of us are investment consultants, and 40% kind of aligned with the research and analytics part of the firm. And we have about $230 billion under advisement. And one important takeaway from Fiducian being independent is to bring objectivity to the relationship. So we don't sell any products, we don't have any funds, we don't accept any commissions. Similar to the talk, 100% of our firm's revenue are derived from hard dollar billables, and that resonates well certainly within the public sector. And I'll talk about the importance of the optics on fee transparency and documenting a process for you, because if there are inquiries from taxpayers or the press, we feel very comfortable that our deliverables really kind of memorialize that process and allow you to make an informed decision. So, back in my days at the City of Hartford, we called it like, you're in a fishbowl environment in the public sector because you have a lot of eyes on you. You're reporting to taxpayers and reporters often, so you just want to be, very transparent. And as a firm, our business lines are law and defined contribution and defined benefit, which is both corporate and public pension plans, and OPEB, which is other post-employee benefit plans as well. And we do a lot of work with endowments and foundations as well. And a little bit more granular on the on the defined benefit practice. So I mentioned we've probably been consulting for about 3 decades now for public plans and pension plans, corporate plans as well. But we have about $17 billion in assets dedicated to defined benefit corporate and public plans. And just to the right, you'll see our public fund experience. We consulted today over 50 municipalities. That's numbers roughly about 55 municipalities, and across about 110 pension plans. So that could be a town pension plan, town employees plan, a police plan, fire plan, and then other post-employee benefit plans. And that's to the tune of about $9 billion in assets. And I point that out because what that allows us to do is really gather a good deal of data points across our public fund clientele with regard to funded status and asset allocation and ADAC and discount rates. And so as I'll point out in a moment, as we work through our fiduciary governance calendar, that information comes out in some of our reports, which allows you to get a sense of what are other plans doing, even plans of similar size like you, around asset allocation and around discount rate and funded status. Do they have a heavier weight to alternative investments, or how are their portfolios structured and aligned? So we use all that data, for the clients that we work with across those 110 or so plans, and work that, through some of our deliverables. And just some recognition within the industry across the lines of P&I and Barron's, just ranking us as a recognized consulting firm, and that's all we do is investment consulting. We don't have any other lines of business. Again, as we point out, we consult to those various lines of business: defined benefit, defined contribution, and endowments and foundations as well. So, the way we view our organization, kind of our structure for our success, is really kind of aligned interests. As I mentioned, investment consulting is our core business. We don't have any proprietary funds, so we think we bring objectivity and independence to the discussion. No money managers or vendors pay to be included in our database. We have an annual client conference, right? So, and we do have some guest speakers from various money management firms, but they don't pay to be included. And really, transparency of costs is key, and our goal is to really inform you, to allow you to make informed decisions on the pension portfolio and act as good stewards and fiduciaries. Now, you're not governed by ERISA ERISA, but you are probably governed by Tennessee state laws around Prudent Investor Act, right? So acting in accordance with prudence and duty of loyalty to the beneficiaries of the plan. And so we kind of work through throughout the year, bestowing committee best practices, what you want to consider as stewards of public fund assets, and then providing that full transparency on your investment portfolio, really the optics. And what I mean by that is there any, is a portfolio liquid? What percentage of the portfolio are in liquid investments versus alternative investments that may be tied up? And then what are the costs of those structures? Are there any type of hidden fees associated with that? So we bring that all out in our reporting. And then at the end of the day, it's just really defining those measurable investment results. So it's driving performance, it's trying to outperform your discount rate with attractive risk-adjusted returns, and really providing you the information to make an informed decision, and really creating that strong and defensible fiduciary trail if there's ever any inquiries as to how the committee made a decision or why is a portfolio structured this way. We feel that we've got a good deal of our work memorialized in our reports and our deliverables that serve as that sort of defensible fiduciary trail for you as stewards of the plan. And there's a little bit more granular on a public fund practice. So as I mentioned, I am head of our public fund practice at the firm, and that's really a byproduct of my experience and having worked closely with public plans over the last several decades. But we are active in a number of organizations, really along the lines of Government Finance Officers Association. So it's not uncommon that we would attend those meetings and be a guest speaker or panelist on a variety of subject matters, and that could be either kind of local within the Northeast or a little bit more nationally. And then we strive to look beyond sort of those routine issues and help pension plans in a variety of ways. So we have assisted those plans that tend to be poorly funded in issuing pension obligation bonds, so working very closely with the actuary and how do you redeploy those assets in a judicious manner across the portfolio. We've also developed investment strategies outside of pension assets or OPEB assets. So some municipalities have what's called reserve pools. These are assets that are not part of operating cash, but they're long-term in nature, so you may have the ability to invest those a little bit more aggressively than sort of in a money market option. So we kind of develop sort of asset allocation strategies toward that end. And then we've worked closely over the years in developing those post-employee benefit trusts, setting a discount rating, establishing an asset allocation strategy, and providing reporting on OPEB plans. So really run the gamut within the public sector, and we also do a lot of work more recently around public fund defined contribution plans. As they become more popular and they've grown in assets, we've seen clients reach out to us and say, we've got this defined contribution plan, it's a 457 plan, it's a 401A plan, we have multiple vendors, we're looking to consolidate, we want the streamlined menu, we have more participants in the plan, we want better optics on that, so we have been doing more work along the lines in DC plans as well as they've grown in popularity, as most plans have tended to be closed to new employees. Our core services, I would say it's very similar to what Natalka has delivered to you, and again, it's going to continue on this pattern. I think we'll expand some of our work around fiduciary support and committee and staff education, regulatory and legislative updates, simply by the work and the very nature of the work that we do in the public space. But ongoing risk management, asset allocation work, investment performance, managing due diligence will continue to be a core part of the service model. I apologize for this slide being a little bit small and granular, but I just want to provide an overview of the service team and the structure at the firm. So to the right, you'll see the service team. Natalka will continue to be a point of contact, but she is supported internally along with myself and other individuals along the lines of operating support, consulting analysts, and performance analysts as well. But we're also supported by our defined benefit business council and our investment advisory committee. And so what that is just we're really leveraging off the thinking of these various committees in the firm with regard to any recommendations within the portfolio. So when we look to make changes, subtle changes, or maybe more meaningful changes, a lot of the information and the sharing of ideas, come from the investment committee and the defined business council. So if we were to go back and talk about Murfreesboro goals and objectives, maybe some of your goals and objectives have changed, it'd be a conversation with the investment committee to get their thoughts and thinking around, how best do we move forward, and those recommendations flow through to Natalka and myself, and we're working closely with the committee to bring those recommendations to you, and so you're really leveraging off the thinking of other consultants that do work in the public space, also our defined business council as well. And then our research team, I wanted to point out our manager research team. So we don't outsource manager research. So all of our manager research is done internally. There is a structure in place. There is an investment committee. There's a capital markets committee. I'll talk about that in a moment. So each year we run our capital market assumptions. They're typically 10 and 20-year outlook. I will add that as a result of the dislocation in the bond market last year, the silver lining has been higher yield. So we are seeing higher return expectations for fixed income going forward. That's a good thing for public plans or asset allocation settings in general, so we can now rely on the fixed income portfolio to harvest some return. And then you'll see we have dedicated dedicated analysts within public equities, private markets, and hedge funds. So again, a dedicated team at Fiducian, and that all they do really is manager research. They're either out meeting with the manager research organizations, and those ideas flow up to our investment committee. Investment committee may go to one of the analysts and say, hey, we've got a couple questions on some of your research. Go back to the organization, ask some more questions, and ultimately the investment committee gives the rubber stamp on that strategy being included in our client portfolios, and that works along the lines of our statuses, right? Putting a manager on maintained status means that it's meeting all the quantitative and qualitative due diligence and the metrics in your investment policy statement. As an example, for concern by a manager and it goes on watch status or termination status, that also flows from the analysts up to the investment committee. And those statuses are consistent across all of our clients, and there's no exception to the rule. So if we have a fund in your plan that is on watch status, as an example, and it's in our other plans, it's also on watch status as well. So there is discipline around that approach. So talk about knowledge and support. I'll wrap up sort of the overview of Fiducian. So we've developed a fiduciary governance calendar, as you'll see before you, which is included, will be included in our quarterly deliverable. So each quarter we take the opportunity to focus in on a particular topic of interest. So you'll see in the first quarter, the focus is sort of a fee analysis, is to bring the expenses of the portfolio and the organization right up front. I talked about fee transparency and the optics of that and why that's important. So what we do is we do a full-blown fee analysis of all the strategies in your plan. We roll that up. What is the aggregate expense ratio? And to determine what funds are daily value, daily liquidity, and do any of the funds have any provisions where they're only monthly valued or only provide monthly liquidity. So we bring that analysis up front so you can truly understand what are the associated costs of the investment portfolio. And typically we also do a review of custodial fees as well. So we bring that fee analysis, front and center. In the second quarter, as an example, you'll see that that's kind of practice and policy focus. So that's where we focus on fiduciary training. So over the years, we have gotten a lot of questions from stewards like yourself that are, what are our responsibilities as stewards of public fund assets? We're not governed by ERISA. We are a little bit different, but what are our responsibilities? What should we be doing throughout the year? What should we be thinking thinking about and carrying out our fiduciary responsibilities. And as I mentioned, most governing bodies of public assets are covered under state statutes, which kind of have a very similar theme to ERISA: duty of loyalty, duty of prudence, best expert rule, et cetera, like that. So, a lot of training with regard to here's some of the things you want to think about throughout the year. Meet on a frequent basis, have meetings, minutes, have a quorum, stuff like that, and kind of memorialize the investment decision. In the third quarter, that's where we kind of leverage off our database, right? As I mentioned, about 110 plans. So we use that information to, what we say is focus on the municipal landscape. So questions around what are other plans doing around asset allocation? Are they more conservative, more aggressive? What are they doing around discount rates? So we've actually seen discount rate trends over the years, but asset allocation strategies have remained relatively static because you just couldn't harvest any return in fixed income. We look at funded status across the plans, and that helps to get a sense of where your funded status is relative to some other plans, and then we work with the actuary. Like we certainly want to participate and attend the meeting where the actuaries deliver in the annual VAL report, because oftentimes there's really good conversation around some of our assumptions or some of your assumptions that are being used, and should you lower the discount rate, and if you do, what is the impact to ADAC, and we want to be part of that conversation because that could influence our thinking around asset allocation, as an example. And then in the fourth quarter is just kind of reaffirming the portfolio's asset allocation strategy. And as I mentioned, that's the time where we run our annual capital market assumptions. And I think over the last decade or so, those numbers haven't really changed much because fixed income numbers have been relatively really low. But if you look back in 2022, with the restoration of higher yields, we have a little bit more optimistic profile of fixed income. Fixed income yields are much higher than where they were a year ago, and that'll benefit the plan, and the fixed income provides that ballast. So now you'll be able to generate more income from the fixed income sleeve. So the conversation we've been having with clients, those plans that have lowered their discount rate, is to say, do you think fixed income plays a little bit of a bigger role in the portfolio going forward? So a client that may have 35% in fixed income, the modeling effort may suggest that we could bump that up to 40 or 45%, still have a high probability of hitting your discount rate and kind of reduce sort of the risk in the portfolio. So that opportunity in the fourth quarter is always an opportunity for us just to relook, re-examine the asset allocation, reaffirm it's in good standing, or come back and maybe make some suggestions that we think over a quarter, 2 or 3, that we could make some tweaks in the portfolio accordingly. So this calendar is really just designed to engender discipline, that we're covering kind of these key topics outside of just the quarterly investment review. So each quarter we're going to do the investment review, what do capital markets do, and how did the portfolio perform, and what do your fiscal year numbers look like. But we're going to touch upon some of these topics within the governance calendar. And then we just provide proactive updates along the lines of Manager Research Group. We have a public fund fiduciary newsletter that we produce as well. So again, we want to be proactive with updates. I think the most recent piece we produced was around Silicon Valley Bank and sort of the contagion risks. We wanted to be certainly upfront with that and letting our clients know about some of the risks there. But our goal is to provide those proactive updates, and again, around knowledge and support on an ongoing basis. I mentioned our client conference, but it is the public fiduciary newsletter, webinars, white papers, and videos, again, is to keep you informed and allow you to make an informed decision, excuse me, with regard to the pension portfolio. So that kind of wraps up fiducian overview. Are there any questions that I can entertain from is it a board or a committee? I apologize.
Committee.
Committee, thank you. Any questions I could answer, perhaps?
I don't see any.
No?
You're doing a great job.
So I guess Nataka, you'll still continue to come down here for our updates. Will you join her, Chris, occasionally, or is that kind of like, just depends? Okay.
Exactly. I mean, I think it's good for you to know that there are 2 or 3 people, as there have been at Chartwell, but who will continue to have strong knowledge of the plan for Freestone and what's going on.
Great.
Mr. Chairman, how are we doing on time?
I'm sorry?
How are we doing on time?
Oh, I think we're doing fine, yep.
What's that, I'm sorry?
We're doing fine. You
Okay,
can
thank you.
continue-
Okay.
Continue on, yep.
Okay, so I thought what we would do is we have the first quarter investment results, and Nataka will go through that in a little bit more detail specific to your portfolio. What I wanted to highlight is just some of the slides that we share as part of the review. So if you look on page 20 here, or up on the screen, there's kind of our market theme, what transpired during the first quarter, and again, we continue to see a good deal of focus on Fed policy, inflation, and the strength of the overall economy. And there was a little bit more optimism, I think this quarter with regard to the Fed would be a little bit more tempered in its approach versus being a very aggressive last year. So as you know, the Fed raised interest rates 7 times in 2022 to really combat stubbornly high inflationary numbers that we haven't seen in 40 years. But as we get here into 2023, we're seeing signs that inflation is abating, and the Fed is a little bit more cautious on its approach, less hawkish, and so we've seen interest rate hikes in February and March of about 25 basis points in each period. And the thinking is that this is working through the economy. The question is, are we going to see a soft landing, or is it going to be a hard landing, like a recessionary environment? I think that's what the market is really battling with right now. Is can the Fed avoid a hard landing as it tries to combat inflation? And I think the challenge there is, if kind of a back of the napkin explanation of what is a recession is 2 quarters of negative GDP growth. I think the real reason why we haven't been in a recessionary environment, hasn't been declared a recession, is a really, really strong labor market, right? So it's a very, very tight labor market. Hiring has been very, very difficult. Employees are kind of in the driver's seat, or those that are looking for work are in the driver's seat. And the Fed is looking at that closely, because when you get a very tight labor market, it can influence wage growth, and that's another component of inflation. So that is one bit kind of thorn in the side for the Fed as it kind of interest rates and kind of slows down the economy. It is certainly cognizant of labor market conditions. And when you had the banking crisis unfold in March, right, we had Silicon Valley Bank go under, and then there was contagion fears around some of the regional banks. The thinking there at the Fed level is that, as that unfolds, banking lending standards are going to get a lot tighter, right? They're not going to lend as much. They're going to have more cash reserves, and that's going to serve to restrict economic growth as well. So the thinking there is, maybe the Fed does not have to be, forthcoming in raising interest rates, and in fact, we may see some cuts later in the year as signs that corporate earnings are declining and the economy is certainly slowing down. So, interesting dynamics unfolding, but it does take time for higher interest rates to work through the economy. So what I'd like to do is focus on capital market performance for the first quarter. So, good deal of volatility. We had a strong January. We had a sell-off in February, and despite the volatility that we had in the beginning of the month in March, with the banking crisis that unfolded, we actually had a pretty solid quarter. We had good returns for fixed income as yields trended lower. So yields did come down in the belly of the curve, and that was a signal that, economic conditions are tightening up, and there's kind of thinking that the Fed may cut interest rates toward the latter part of the year. But if you look at the Bloomberg U.S. Aggregate Bond Index, really it kind of that serves as the barometer of the U.S. bond market, kind of right around there. It was up 3% for the quarter, and this is coming off a disastrous 2022. It was the worst year on record for the Bloomberg Aggregate Bond Index since 1976, and that was the inception of the index, so it was a very difficult year. But for the quarter, we saw about a 3% return, and then overall fixed income returns were positive as rates came down. You can see high yield bonds, which are more sensitive to the strength of the economy than interest rates, were up about 3.6%. So fixed income, kind of did what it's supposed to do, is provide that ballast, reduce some volatility in the portfolio, and that hasn't been the case over the last decade, right? Over the last decade, even though discount rates for public plans have come down, asset allocation strategies remain relatively aggressive because you couldn't harvest any return in fixed income, so you had to get performance somewhere else in the portfolio. You had to get it from domestic equities, international equities, real assets, alternative assets like private real estate or private equity, because fixed income yields were just not there. Now that we have yields restored to more normalized levels, fixed income, now provides that ballast in the portfolio where even if rates don't move, you're going to generate some attractive income, and that's exactly what we're looking for fixed income to deliver on a go-forward basis. So outside of fixed income, some good news there, despite what happened in 2022. Global equities were higher as well, but there was really a difference in return for equities in the first quarter. And this was really led by sort of a risk-on market led by growth names. So you may recall last year, growth stocks really got hammered. Think of the Amazon, Apples of the world, Netflix, Meta, Tesla. Those type of companies with really rich valuations really sold off sharply because the relative appeal was now competing with higher yields. As rates kind of came down in the first quarter and investors were looking at more profitable companies, you can see that growth stocks did very, very well relative to value. So the dynamic in the story really changed. The S&P was up 7.5% for the quarter, and if you look just down below, the Dow Jones Industrial Average was up only 90 basis points, less than 1%, because it has a very sort of cyclical bias. And the NASDAQ, which is tech heavy, was up 17%. So just to put it in perspective, information technology within the S&P was up 21% for the quarter. The financial sector within the S&P was down 5.5% for the quarter. And you can see that with some of the numbers here. And as you descend in capitalization, the returns were a little bit smaller because regional banks make up a bigger portion of some of those indices. So the Russell 2000 was up 2.7% as an example. And the positive returns weren't just isolated to the U.S. markets. International markets did well as during the period as well. So the MSCI EAFE, which is sort of the developed markets index for international investing, was up about 8.5%, benefiting from a weaker dollar, but it was also a very mild winter in Europe. So energy prices came down. You remember at the beginning of 2022 with the war, there was real concern that Europe would struggle during the winter under tremendous pressure from higher energy prices, and that didn't unfold. So the economy actually in the Eurozone was a little bit more vibrant than many economists had expected. So international markets like the Eurozone was up 8.5%, and then emerging markets were up 4%, again, as China reopened, and then you had some onshoring of some of the supply chain issues. So supply chain was a little bit more fluid. So overall, you can see fixed income was positive for the quarter. Equities were positive for the quarter. And just below that, you'll see some of the real assets like REITs were up 2.7%. Commodities were down a little bit, down about 5%, really pressure from the energy sector. But overall, it was a good quarter. Now, this is on the heels of a pretty good fourth quarter. And now we have a good first quarter. And I point that out for plans in a fiscal year. We're 3/4 of the way of this fiscal year ending June 30th. And when I canvass some portfolios within the public sector, we're looking at fiscal year-to-date returns through the end of March, ranging anywhere from about 5.2% to 6.5%, right? So not bad. We still have 3 months to go. But again, if you were to look back just 6 months ago, those returns were not so good. So again, a good fourth quarter, a good first quarter, a little bit more optimism that, we could end the fiscal year on a positive note and really kind of, get to that discount rate level at around 7% or so, but, fingers crossed. But we do anticipate some volatility on a go-forward basis as earnings results are released. You're going to see some weakness in the economy. Market's going to be focused in on the Fed and always some geopolitical risks. So that provides really the first quarter overview, and maybe I'll turn it over to Natalka to go through portfolio results if there's no questions that I could field. All right.
Thank you, Chris.
So nice to deliver better news.
Yeah. You're good?
Okay, and then,
You could, yep, just,
okay.
you could also, it's sensitive.
It's very sensitive, right? Okay,
Go this way.
there we go. See, it's not just me.
It's states where you could draw.
It's really bad.
Pretty neat system.
Okay,
Everybody has
all right. If you'd like to follow along, because I know that the screens can be tiny, but behind tab 3, page 29, we'll start off with how all of this market and economic activity has impacted your plan. So on page 29, the top table, we see the asset value summary of the plan. The plan started the year at $155.6 million in assets. It ended March 31st, ended the first quarter at $160.8 million. During the first quarter, there were $489,359 of net outflows from the plan, so benefit payments and other plan expenses, and you experienced $5.7 million in investment gains. So as Chris said, it was a pretty solid quarter, volatile but solid. In the table below, we see the plan's performance sort of from a top-down perspective. The total plan edged ahead of the index for the first quarter, returning 3.7% versus a 3.4% target. You have 4 investment teams, or composites, if you will, that make up your total plan. So from a return standpoint, let's see who contributed and who maybe detracted from total plan performance. The real assets team and the fixed income team finished a little bit ahead of target. The fixed income team posted a 2.8% return versus a 2.7% target, and your real asset composite was up 1.1% versus 0.9%. The international team was really sort of the star performer for you in the first quarter. The team posted an 8.3% return versus a target of 5.6%. The laggard of team this quarter was the domestic equity team. They rose 4.4% versus 7.3%. And we're going to take a look at each of these teams in a few minutes, and we'll sort of delve into what created the lagging or the leading performance. But from a top-down perspective, the plan had a solid quarter of performance. You also had a very solid quarter of performance in the third and fourth quarter of last year. So I'm hoping that for your June 30th results, if markets hold together, that you'll be in that 5.2 to 6.5% range, and maybe at the higher end of that range. Okay, let's take a closer look at the fixed income team. You have 4 managers in fixed income. Your largest manager is TCW, Total Return. They focus in on mortgage, backgrounds, I'm not sure why that, but they focus in on mortgage-backed securities and asset-backed securities, and they rose 3.6% in the first quarter. We compare them to both the Barclays Aggregate Index as well as a mortgage index, and generally they fall in between the two. This time they beat both, which was a good thing because last year this manager was your worst performing fixed income manager. High-quality mortgage-backed securities did not fare well in the market last year, and that shows up in the trailing one-year return numbers, but they're beginning to dig their way out of the hole. The next largest manager is Pinnacle Fixed Income. They're your core intermediate manager. They tend to focus on intermediate corporate bonds. They don't really own any mortgages, a little bit of government bonds. It's primarily an investment-grade corporate bond portfolio, and they virtually match the intermediate aggregate index in the first quarter, rising 2.2% versus 2.4%. You then have a high-yield manager in Lord Abbett High Yield. They lagged about 1% in the first quarter. They tend to focus in on some of the lower quality, riskier assets, and those did not fare as well as the higher quality, high-yield bonds in the first quarter. And then you have Western Asset Income, which is a multi-sector bond fund, and they were your second best performing manager this time. They also invest quite significantly in high yield and bank loans, but they also invest in commercial mortgage-backed securities, investment-grade bonds, asset-backed securities. So as the name implies, they are a multi-sector bond fund, and they're focusing on income generating opportunities within the bond market. And they've been a strong manager for the plan since their addition. So that's the fixed income team. I'm going to move on to equities, if there aren't any questions. Your equity team is 6 managers. Your small cap growth and small cap value managers in the first quarter were the only 2 that outpaced their target indices. As I mentioned earlier, the domestic equity team was the laggard team in your total fund performance, and that was primarily driven by the value managers in your portfolio. If you look through your large cap value manager, Brandywine Dynamic Large Value, or Harbor Mid Cap Value, they underperformed their targets slightly, but their asset classes significantly underperformed their growth counterparts. So when you look at Harbor Mid-Cap Value versus Janus Enterprise, which is a mid-cap growth fund and was your top performing manager this year, you can see the difference between value and growth, as Chris highlighted in his earlier comments. Pinnacle is your large cap core equity manager. They have sort of a very S&P 500 tilt to them, if you will. They lagged slightly, and because of the size of their exposure in your portfolio, when they lag, it does create a bit of a headwind for your portfolio. But they're doing a very solid job. I'm going to be meeting with them after this meeting, but they're doing a solid job. It's been, a tough market for core equity managers. The rest of the team, as you can see, very competitive results. And I would also say, if you look at the one-year column, there's a lot of red numbers in there. But most of those red numbers are lesser losses than the target index. So your domestic equity team last year defended pretty well within their space. So from that standpoint, none of these managers are on any type of a performance watch list status at this point. Okay. Next, we're going to take a look at your international and global equity team. You have 4 managers, 2 global managers at the top. American Funds Capital World Growth and Income has more of a value orientation and does include investments in emerging markets. Janus Global Research has more of an international growth focus, and they do not invest in emerging markets. You have a dedicated international manager in Dodge & Cox International Stock, and you have a dedicated emerging markets manager, Invesco Oppenheimer Developing Markets. I'll start at the bottom because that's sort of an eye-popping number. Emerging markets, the index was up 4%. Invesco posted an 11.3% return. Invesco was the worst performing international manager last year. Emerging markets had a difficult time because of the sanctions that went on Russia and the elimination of them from the index. The first quarter of last year was very tough for most emerging markets managers, but they, in the last 2 quarters of last year and first quarter of this year, have really come back strong, such that when you look at their one-year return now, I mean, it's almost flat versus the index being down 10.7. Dodge & Cox has a little bit of a value bias, hurt them in the first quarter a little bit, they lagged a little, but the trailing one-year return, they were down 0.5% versus down 5% for the index. And both of your global equity managers also dropped a lot less last year than their indexes. And if you do a side-by-side comparison of the trailing one-year returns between your domestic equity team and your international team did a better job at defense in both absolute and in relative terms. And I think that that's just something that you wouldn't expect given all the issues going on geopolitically in the world, with the war in Europe, with China reopening and, some, tensions there. I don't think a lot of people thought that international would outperform U.S. in 2022 and in the first quarter of 2023. So we like your team because they're doing well in a difficult space. And as I said, in both relative and absolute terms, they're doing quite well. We had Invesco Developing Markets on watch list status last year because of their significant underperformance in the first quarter as they were adapting to taking their Russian holdings down to zero dollar value in the portfolio, but they have recovered and rebounded nicely. And then your real asset team, we'll finish off with them. You have 4 real asset managers, 3 in the REIT space, real estate investment trusts. 1 is global, Prudential Global REITs, and you have 2 domestic REIT managers, and you have a natural resource manager. Last year, as you might recall, the natural resource manager was probably your only positive performing manager. Natural resources did very well. They retreated a little bit with the falling price of oil and the pullback in some agriculture and precious as well as industrial metals pricing. So a negative return in the first quarter of -3. It's an index fund, so it pretty much matched the target index. And your REIT managers, REITs had a tough year last year with the rising interest rate environment and the question mark over reopening office space and what impact that's going to have on the REIT market. REITs underperformed traditional equities last year, and off to a slow but positive start in 2023. The Prudential Global REIT Fund, just for your reference, currently they are 65% invested in the US and Canada. That's their North American exposure. 25% in Asia, primarily Japan, Hong Kong, Singapore, the developed Asian markets, and then about 11% in Europe. And your REIT team is holding up well in a difficult space, and I'll have some more comments about the REIT space in a few minutes. But before I move on to asset allocation commentary, any questions on any of your investment performance or plan performance? You're getting a more detailed performance report this early after a quarter end. Some data did not become available for us to generate the full performance report, where we normally have some commentary, some fact sheets on your mutual funds. That will be coming to you in a few weeks, but we did have all the performance numbers at least, so we wanted to share those with you. Okay, so the last page of the presentation, or page 35, we'll take a look at the asset allocation of the plan. On the right-hand side, lower right-hand table, you see the strategic asset mix, or the broad targets for your plan. Your target is to be 42% in traditional equities. That's domestic, international, growth, value, all the capitalization ranges. 23% in real assets, so that's your real estate and natural resources. 34% in fixed income, and 1% in liquidity. We like you to have some operational cash on hand to meet your benefit payments and plan expenses. So in essence, if we break this out at a higher level, your asset mix is a 65-35. 65% in equities, because your real asset exposure is in the form of real asset equities, and 35% in fixed income, including your cash. If you look at the table above, you'll see the current mix, which is how you're actually allocated right now vis-a-vis those targets. So your target total equity exposure is 42%. You're at 48.7%, so almost 49% overweight in traditional equities. And that overweight is pretty much across the board in large cap, mid cap, and small cap. And it's also across the board in international. Those funds have performed well. And despite us doing a lot of trimming, they keep growing back. So it's a high quality problem to have. Your real assets exposure, the target's 23%, you're at 21.4%, so a little bit underweight there because of the relative weakness of the REIT performance last year. Your total fixed income exposure is also underweight at 28.3% versus a 34% target. And your liquidity, your operational cash, is overweight. Since the pandemic started, we have recommended that you keep almost double the weight in operational cash so that you have 6 months plus of cash on hand, so that given the month-to-month, given the week-to-week volatility that we see in the markets, we don't want you to be in a position at the end of a month sort of saying, okay, what do I need to liquidate to make my benefit payments? So when the market's going through a particularly volatile time, in the back of your mind, you should always keep in mind that, you know, you have 6 months of cash on hand to pay your bills, to pay your expenses, you know, no rash actions required. So from a rebalancing standpoint, we have a couple of recommendations. If we go back to page 34, this is your March monthly flash report where you see your market values in all of your managers. And the last column is our proposed rebalancing. And we're recommending trimming your higher yielding riskier fixed income, so the high yield bond fund and the multi-sector Western Asset Income Fund by about $500,000 each, and deploying that money into higher quality fixed income, and putting that in Pinnacle for right now. So this sort of ties in with a couple of themes that we're looking at for your plan. Something that we talked about even during the fourth quarter report was that we were going to take the opportunity after the sort of the devastation that occurred in the bond market last year to sort of upgrade your quality in your fixed income portfolio. Rather than sort of extending duration at this point in time, we think that because of the higher yields, the more normalized yields that Chris referred to in fixed income, it's a good time to maybe look at shifting out of some of your riskier fixed income investments and going into higher quality. I think that one of the things that we'll be looking at in that regard as well is adding another core high-quality fixed income manager to the team. We might sort of reduce TCW's total return bond fund exposure a little bit. They do have a tremendous focus on mortgage-backed and asset-backed securities, and those are recovering as well, and they're certainly higher yielding. But we think that, having a good core bond, high-quality manager, particularly if we're going to be increasing your allocation to fixed income, makes a lot of sense. So we'll be taking a look at the managers as well as the overall allocation to fixed income and coming back to you with some suggestions. I mean, currently, your high yield and your multi-sector bond funds, I mean, they're doing very well. And we don't think that, that the market's going to give way necessarily this year in high yield. But it's a good time to trim on strength and upgrade the quality in your fixed income portfolio. I mean, when we look back at, sort of asking the question, well, why do we have high yield, or why do we have multi-sector bonds, or why do we have REITs? For the last 8 to 10 years, we've been in a zero interest rate environment. And if everybody was searching for yield, whether it was in equity markets, whether it was in real assets, whether it was in fixed income, and people were getting sort of, I'm not going to say pushed, but funneled towards perhaps more aggressive or riskier strategies to get some yield in the portfolio. And so now we may have an opportunity to dial back on that risk a little bit and still have a high-yielding portfolio. So, fixed income might be back to doing what it's been intended to do for a long time, and it's been on like a 10-year timeout. So that's something that we're looking into, and we'll be coming back to you with recommendations. The other thing that we're looking into, and it sort of fits into the same theme, is perhaps reducing your target to real assets. Currently, it's 23%. 6% of that target is in natural resources and commodities, and 17% is in your REIT exposure. It has served the plan very well. that combination. I mean, the Resources and Commodities Fund, you know, up until the pandemic was sort of a struggle. Since then, it's been the top performing real asset in your plan. And the reinvestments were put into the portfolio, again, for income generation purposes, a little bit as surrogates for fixed income. So, you know, now that we have some more opportunities in high quality, less risky fixed income, we're thinking about dialing back the allocation to REITs and redeploying that money into fixed income. So maybe changing the strategic target a little bit. So going from maybe 35% in fixed income, that target, up to 40 or 45%. Probably 40, but we'll see how it goes. But we're going to get back to you on, you know, with our thoughts on that. And again, it's not because we don't like your REIT team. We think that they've done a great job for you in their space. But we think that that space is going to be a little bit challenged going forward with higher interest rates, with what's going on in the banking sector and its impact on commercial real estate. So it might be a good time again to sort of trim on strength and, you know, sort of take a look at the risk-return profile of the plan and better match those things up, since new and better opportunities have presented themselves. So, a lot of information on markets, on plans, on, you know, sort of future discussions. Any questions that we can field?
Do I hear you saying that we move our portfolio to a more conservative position on the basis that the Fed, if they don't get inflation under control, we're going to be sitting there with a zero return because those rates are going to go up, and we're going to be faced with that in that bond portfolio. If they do get inflation under control, this seems to be what you're trying to tell us in a kind of clouded way. What is your position on that, or how does that go into your thinking with regard to us going to a bond position?
Well, within fixed income, we still think there's going to be some rate volatility for the next year or so, both on the short end as well as the long end of the curve. And that's one reason why we're not really suggesting at this point in time that we change duration in your portfolio. We have kept the duration for a number of years now in the intermediate category, and even your mortgage-backed security portfolio has a lower duration than a traditional core bond portfolio. But we think that with the increase in yields in high-quality bonds, that even if there still is rate volatility that sort of negatively impacts the total return of fixed income, the income component is going to support it a bit better. So we want to take advantage of the opportunity of getting into some high-quality fixed income investments while the coupons are really high, and not dial, you know, up the duration, keep the duration the same, and you know, sort of ride, hopefully, the rising tide within fixed income. So
you bet the Fed's going to get inflation under control and rates are going to go down?
I think that yes, I think that I don't know that it's going to go down to the 2 or 3, 2% level, but I think they'll get it down to.
So we're finished going up much.
Yeah, I think that the wild card is employment and what happens with employment. And
yes, that is the wild card. Yes,
that's,
I agree.
The delicate balance, because, sort of the Fed has that dual mandate of inflation and employment. And right now, all of last year, they were really focusing in on inflation. And I think that we're seeing, some of those numbers come down on a year-over-year basis. Employment still remains quite strong. So I think that they're trying to get inflation under control without destroying the labor market.
So your research is telling us we're looking at a soft landing somewhat.
Yes, I mean, somewhat so far, so.
But don't hold her to it.
The other side of this, though, it's a bird in the hand. You're getting some revenue.
Yeah.
We need income, and we're taking risk off the table. I think that, to me, is what.
Oh, no, I don't,
What I
I don't think that's a bad deal. I'm just trying to figure out what your thinking is. And so,
Yeah, so, I mean, we do think that there's probably, a recession. We've sort of danced around, are we in a recession, are we not in a recession?
Yeah.
One can make the argument that certain sectors and certain things, I think, have been in a recession, others have not been in a recession. So, I don't know if we're ever going to get to the point of where somebody is actually going to say, we're in a recession.
wouldn't be a good time to be a Fed governor, would it?
I don't know that they can do anything right, It's like they're damned if they do.
There you go.
It's always a good time to be a Fed governor.
Okay.
Is that what you might move on to, Charlie?
Yeah.
Did I miss the point there? I missed the point there, didn't I?
Yeah.
Sorry.
So, no.
Never a bad time.
I have one quick question. I know that I wasn't here at the last meeting. We talked last year about investing in that private equity fund.
We were looking at a couple of years ago, doing private real estate versus the REITs.
Yes, and that never materialized.
No, and,
Thank goodness.
Yeah,
I was going to say,
yeah.
I'm really happy about that. I mean, not that private real estate has done poorly, but as of last summer, all the private real estate funds have thrown up redemption gates. You can't get money out of them right now.
That's, yeah.
We dodged a bullet.
So, but also, we were in the Western Asset Income Fund for the first 18 months, that was a private debt fund. Yeah. And you were in that. And then they sort of closed, they sort of paid out the private debt fund to the Western Asset Income Fund. So, and that was, increased I'm happy that they did that, just because I'm a liquidity kind of gal. I like to be able to get in and out of investments if I have to, so.
Good, thanks.
Well, if there are no objections to Nataka's suggestions on the rebalancing, then Nataka, you can send those instructions over to me and we'll get that worked up right away.
Will do, and I'll send them from both email addresses until we get that
I do have
straightened out.
confirmation from our IT director that we are all set and your emails are now out of quarantine, so they're
okay.
coming through.
Okay, great. Well,
Your emails weren't vaccinated, obviously.
Well, thank you very much for your time and attention and good questions as always. And it's, really looking forward to continuing working with you. And, we have an opportunity here to, I think, make some adjustments to the plan that we've been sort of waiting and hoping for. And so, we look forward to bringing those to your attention. And Charlie and Melissa, I'm going to miss you.
Yeah.
So, but, it's been wonderful working with you.
Yes, thank you.
We feel the same. I remember when we hired Chartwell, I was telling Nataka before the meeting, that was a big step, hiring an outside consulting firm, and I sing her praises. It's been, I think, a really good relationship for the city.
When did that relationship begin?
98.
I think
hate
I
to
must
think-
have come on board about 2000, I think.
It wasn't too
somewhere in
long
there.
afterwards.
Yeah.
Because we had a
Because you
board
were
member
here
roll
then.
off, And we appreciate those who give up your time to come and help make this big decision. There's a lot of employees counting on these funds, and, you know, this is not a paid committee, so we always appreciate those who are willing to come and serve.
It's our pleasure. Thank you, Natalka.
Yes,
Thank you, Chris.
Thank you, Chris, for coming, yes.
Best wishes to the new marriage.
Yes. All right, I guess we stand adjourned.
Y'all have a couple of other information items in your agenda. One is the annual compliance letter that we get from the state, just confirming our compliance there. And then Employee Services puts together an information sheet each year that covers our history of contribution rates and general funds contribution and dollar and percentage of payroll numbers. So if you have any questions, let us know, and we can research whatever those questions are as well. And yeah, absolutely, I would thank Melissa and Charlie for your years of service. 20 years was Charlie.
I think it's at least 20, but I'm not sure.
We asked our finance director's office or city recorder's office to check that, and it looked like back in 2003 was when you were appointed. So
Sounds about right.
exactly 20 years, and Melissa was right at 15. So definitely appreciate you staying on after retirement, and you as well, Charlie. So thank y'all both. And if you didn't get breakfast, please get a bite to eat. We definitely appreciate y'all. Thank you.
Thanks, Aaron.
Thank you. Okay, we stand adjourned.